Very good afternoon, everyone. I welcome back for all of you for this second session on capital structure and firm valuation. To give you a brief introduction or overview, what we have seen yesterday. Yesterday, in the first lecture, we have seen about the meaning of capital structure, the different sources of or the components of the capital structure, what are the various internal and external factors that comprises and are the components which affect your capital structure decisions. Then further, we have seen what is an optimum capital structure, and with respect to the essential elements of a sound optimum capital structure, that is OCS. Then we have also dealt with and seen the different sources of long-term finance that are available, wherein you can raise the amount of capital that has been required in a combination of either equity, preference, and debt, the determinants of sources of capital. And we have also seen or dealt with the break-even EBIT of earnings before interest and tax. Now, today onwards, in this today's lecture, we are going to see with the net income approach, the net operating income approach, the traditional approach, and the Modigliani and Miller approach. So, different types of capital structure theories we are going to see in detail. The first, now before understanding the capital structure theories, what different type of structure theories it is, you need to understand or take into consideration what is a capital structure. So to just summarize or overview, capital structure is that particular composition or a certain component wherein an optimum capital mix of a particular combination or a mix of debt and equity which a company uses to finance its long-term operations. And a capital structure refers to the proportion between the various long-term sources of finance that you are using or utilizing in the business organization. Now, you being a financial manager, you have to choose that sources of finances, which includes maximum risk as well as a minimum cost of capital. So minimum risk and minimum cost of capital, the certain components wherein you get, then you can optimize and you can utilize those sources of funds that are available. The assumptions of capital structure theory. So common assumptions with respect to all the capital structure theories are being summarized in this slide. The firm uses only two sources of fund, that is perpetual risk debt and the equity. So it is basic essential assumptions of a capital structure that what you have to do, you have to take into consideration only two sources of fund. So there are no other or different types of sources of fund, only equity and debt are the two sources of fund that is applicable and that is used by the firm. There are no corporate taxes or income taxes or any of the personal taxes. So there is no inclusion or there is no combination or composition of any types of taxes into picture. So there is no either corporate tax or income tax or type of personal tax into existence. The concern with respect to the dividend payout ratio, the dividend payout ratio is at 100%. That is wherein you mean that no amount is being set by the organization for in the terms of general reserve or retained earnings. So and profitable to the organizations. Next perspective, the firm's total assets are given and do not change at any point of time. So what happened, whatever the valuation of the firm it may be, whether it may be equity capital, debt capital, or whatever type of capital, you have a proper optimum capital utilization and you have the valuation of that particular debt or equity or the investments amounts also. Another concern that we need to take into consideration is assumptions of a capital structure with respect to the firm's total financing remains constant. So whatever may be the time, whatever may be the situation, the amount of financing of this particular firm remains constant over a period of time. The total capital is not same. Capital is same, but the proportion of debt and equity may change. So whatever the amount of total capital, whether it may be, for example, 100 crores, 200 crores, or 500 crores, the authorized capital and the requirement of amount of capital do not change accordingly. The firm's operating profit, that is EBIT, are not expected to grow. So it is always at a stable state, and it is the operating profits of the firm are not changing. So it is another assumptions of your capital structure theory. The business risk is remain constant and it is independent of capital structure and financial risk. So whatever may be the situation, whatever may be the terms and changes in the market conditions, market situations, the capital structure and financial risk, and from this particular perspective, the business risk is always remaining a constant. So there is no additional involvement of risk. All the internal and external factors are constant. Furthermore, all investors have the same subject profitability distribution of the expected EBIT for a given firm. So the investors amount is also stable. All the components, the returns, the rate of return, what has been expected, the probability distribution of equity and debt, the expected EBIT of a particular firm or a capital structure is also same. So all factors remain constant. And lastly, the firm has a perpetual life. That is, the business activities keeps on going again and again, and it does not change accordingly. So here at this point of time, we have seen the different assumptions with respect to the capital structure theory. Now coming to the first theory that is available with us, that is NI, that is net income approach. The net income approach, it has been suggested, and this particular theory is been proposed by David Duran. According to this approach, the value of the firm is increases and decreases overall cost of capital by increasing the proportion of debt financing in the capital structure. So here, this particular theory of net income approach, it specifically focuses on the value of the firm. So whatever may be the concern, whatever may be the situations, your value of the firm is always increasing and it decreases depending on the cost of capital. Now, this particular cost of capital is directly proportional, it is directly affected with the increase in the proportion of debt financing in the capital structure. So if your debt financing increases, the value of the firm increases and the overall cost of capital decreases. And if your debt financing decreases, your value of the firm will decrease and your overall cost of capital will increase. So in this way, the David Duran's net income approach is proposed. Net income approach also states that a change in the proportion in capital structure will lead to a corresponding change in capital valuation and the total value of the firm. So cost of debt and cost of capital, that is overall valuation of the firm, changes with respect to the change in capital structure. So whatever may be the concern, whatever may be the market situations, if your debt financing or if your proportion of debt and equity changes, the net income approach clearly mentions, it states that your cost of debt and valuation of capital or the valuation of the firm changes accordingly. It is due to this fact that that debt is generally a cheaper source of finance. Why? Now, why debt is treated to be as a cheaper source of finance? Because interest rates are lower than the dividend rate. So at this point of time, we can see and understand that the rate of interest at this at the debt capital is always low than the dividend rate that you have to pay. So if the debt capital is available at 2% or 3% or 5%, but in the other situation, the equity rate or the dividend rate that you have to pay to the equity shareholders is quite higher at this position. Next thing, second aspect as to David Duran's net income theory is benefits of tax is because it is deductible and expense. So at this point of time, when you are considering the cost of capital, the benefit of tax is available because it is a deductible expense. So whenever a particular tax amount has been deducted from your capital structure, that is EBIT, your overall or total cost of capital or total valuation of the firm, that is the net report or the net income that has been generated, it automatically decreases. So here what we need to understand or we need to take into consideration, if the tax amount is increases, your deductible expenses is also increasing and your net income is also increasing simultaneously. Assumptions of the net income approach, the cost of debt is lower than the cost of equity. Yes, we have seen in the introduction itself, because if the amount of debt is lower, then your cost of capital is much higher. So here the assumptions of the net income approach by David Duran clearly mentions the cost of debt is lower than the cost of equity. Second assumption is with respect to the risk perception. The risk perception of the investor is not changed by the use of debt. So whosoever may be the investors in your business, whether it may be a small scale, medium scale, or the frequent investors, their amount of investment, their pattern of investment is not changing, whether it may be a capital investment or with respect to debt or equity, and there is absence of taxes. So there is no corporate tax that has been levied by the respective government authorities, and there is no availability of taxes at any point of time. Now here, furthermore, now we see the graph of net income approach. The net graph of net income approach, you can see E is equal to NI divided by KE. So E, that is your cost of equity, is equal to the net income divided by the cost of equity. So at this point of time, you can clearly see the different cost of capital that is made available and the degree of leverage, that is D divided by E. So your composition of the debt and equity is always must be at a certain optimum level, wherein at every point of time the proper optimum capital structure mix has been maintained and there is no additional income or a source or a expense to the organization. So all other factors remaining constant, your income level changes, your cost of capital changes with respect to your proportion of increase or decrease in the debt financing. That's all for net income approach. Now we move towards the net operating income approach. Net operating income approach says that there is no relationship between the capital structure and the cost of debt and cost of or the valuation of the firm. So net income approach specifically says that there is no relationship between the capital structure and the operating income and the valuation of firm. So here again, this particular theory was again proposed by David Durant, and it is also known as an irrelevant theory. Why? Because from the definition itself, from the statement itself, we can see that he's saying that there is no relationship between the capital structure and the cost of firm and the valuation of the firm. So net operating income, that is KOV, that is value of the firm, and capital structure. So all these three components are dependent on each other, and we cannot say that it is an independent situation. So this particular theory is also a certain concern wherein it is called as an irrelevant theory, because all these particular three components, that is capital structure, the net operating income, and valuation, are completely dependent on each other. So furthermore, according to this theory, the total market value of the firm is not affected by the change in the capital structure, and overall cost of capital remains constant irrespective of debt equity ratio. So in this particular sense, what David Durant says, that the total market value of the firm is not affected by the change in capital structure. So earlier in the net operating income, what we have seen, the net operating income clearly states that your capital structure gets affected by the with the increase or decrease in the debt financing. But in the net operating income approach, what David Durant is again proposing, he is saying that the total market value of the firm is not getting affected. But in real terms, what we see in real terms, we can see that it is perfectly getting affected with the change in the capital structure of either the debt financing or the equity financing. The overall cost of capital remains constant irrespective of the debt equity ratios. But here in actual scenario, in actual terms, what we can see, the overall cost of capital is perfectly changing, because it is having either a positive or negative impact on the overall cost of capital, and the debt equity ratio, it's directly impacting your business activities or business transactions or your cost of operations. Now, continuation with the net operating income, let's look at the various assumptions of net operating income approach. So with respect to the assumptions of the net operating income approach, first thing is the overall cost of capital. So overall cost of capital remains unchanged for all degrees of leverage. Whatever may be the degree of leverage, whether it may be a operating leverage or financial leverage or combined leverage, your overall cost of capital remains unchanged or same or stable. The market capitalizes the total value of the firm and as a whole, and no importance is given for split of value of firms between the debt and equity. So the total market value of the firm as a whole, it is always increasing and it is always being stable for every point of time. So at this point of time, what we can say, the total value of the firm, it does not keeps on changing. Next concern, the market value of equity is a residual value. So total value of the firm minus the market value of the debt is your market value of equity. So whatever the amount that has been made left over or is made available at the end, that particular value is called as a market value of equity. Now this market value of equity is a residual value or a remaining value. Now how this particular value has been calculated? It has been calculated with the formula that total value minus the market value of debt. So the total value, that is the total earnings of the organization, minus the debt value of the, or that is the debt value, which is specifically the market value of the debt, the remaining amount will be the market value of equity. Fourth perspective of assumptions is the use of debt fund increases the received risk of the equity investors, thereby cost of equity increases. So the increase in the debt financing is always automatically increasing the equity financing also. So in order to be a optimum capital structure, so if your equity financing is increasing, simultaneously your debt finance must increase. If your debt financing is increased, simultaneously your equity finance must also increase. Fifth perspective, the debt advantage is set off exactly by increasing the cost of equity. So whatever may be the cost of equity is into existence, your debt equity, your debt advantage is automatically set off by increasing the cost of equity. Next perspective, the cost of debt remains constant. So yeah, at every point of time, KI, that is the cost of debt, is always remaining constant and it is not changing at any point of time. And lastly, there are no corporate taxes as it is a general assumptions with respect to all theories. So there is an absence of corporate tax or income tax or any type of tax into this concern. Now let's look at the graph or chart in which respect to the change in net operating income you can see. So in this particular diagram, you can clearly see that at a certain position, the cost of debt is available at a certain position, that is a cost of equity is available and a certain cost of level cost of financing or overall total cost of capital is made available. So KI, KD and KE is a particular concern wherein you can see after a certain position or after a certain point of time, the KE, the curve, that is the cost of equity curve, keeps on increasing and KO, that is cost of overall cost of capital, remains unchanged or constant, whereas the debt financing is similar or stagnant. There is no change in the debt financing, that is KI. Here, the valuation of the firm or overall cost of capital is with respect to the EBIT divided by K0, that is overall cost of capital, and E is equal to V minus D. The degree of leverage, it can be calculated by the formula D divided by E, that is displayed in the picture. Now, third perspective. Now, let's look at the third perspective, that is the traditional approach. This approach is a midway of net income approach and net operating income approach, and it is also called as an intermediate approach. So, with respect to the advantages and assumptions and limitations of the net income approach and the net operating income approach, what happened? A new proposition or a new traditional approach has been introduced, and this particular proposition is called as an intermediate approach or traditional approach. According to this value, the value of the firm, according to this particular approach, the value of the firm can be increased initially or the cost of capital can be decreased by using more debt, as the debt is cheaper source of funds than equity. So it is an adoption of net income approach wherein we have seen that you have to increase the debt financing. Now, why we have to increase the debt financing? Because it is always treated as a cheaper source of finance. So if the debt finance is of a cheaper type or cheaper nature, then availment of debt financing should be of a higher position or a higher level as compared to equity finance. But after that, optimum capital structure can be reached by a proper debt mix. So after a point of time, when your debt finance is increasing and equity finance is remain stable, what you can do, you can bring in at a certain position that by increasing after a certain level, the optimum capital structure can be reached by making a proper mix of debt and equity. Now, after a particular point of time, if the proportion of debt is increased, then overall cost of capital starts increasing and market value becomes to decline. But after a proposition, what has been found out, if the debt value is increasing at a very stagnant stage or a certain period of interval, then the overall cost of capital starts increasing and your market value of the firm, it declines or it decreases. So in this way, the traditional approach is it has been proposed. Now, seeing it in a diagrammatic way, where you can see the stage 1, stage 2, and stage 3 of your traditional approach, wherein physically you are increasing the debt finance. Now, in this particular concern, KE, KO, and KI are the respective concern, wherein it shows your overall cost of capital, the cost of equity, and cost of debt. So, in terms of your KI, that is cost of debt, what you can see in stage 1, it was increasing at a very stagnant stage, but in stage 2, it is no change, and at stage 3, your cost of debt starts increasing gradually. So, after a certain point of time, it will reach a certain position that it will meet KE, and your equity and debt financing will be at a same position, and it will make a certain combination that your KO, that is cost of capital, will be provided accordingly. And same, the degree of leverage will be D divided by E. The same formula applies for each of all the three methods. Now, lastly, coming with the fourth perspective, that is the Modigliani and Miller approach. This particular Modigliani and Miller approach, it's that what so total Modigliani Miller approach specifically focuses on a particular concern wherein whatever may be your total valuation of the firm, whatever may be the availability of cost of equity, cost of debt, availability of finances, combination of equity and debt. So at this point of time, the value of the firm is independent. It is not getting affected at any point of time, whatever may be the composition or structure of your capital. They have given two approaches, that is in absence of corporate taxes and in presence of corporate taxes. So at this point of time, what we need to see, we need to take into consideration if corporate taxes are into existence and if corporate taxes are not into existence. So Modiglani Miller position is not considering or not taking into consideration any type of equity or debt financing proposition, but it specifically focuses on the concern of corporate taxes. Now, assumptions with respect to the Modiglani and Miller approach. Capital market are perfect. So, with respect to the capital market situation, Modiglani Miller position takes into a certain consideration that your capital market are at a certain situation wherein it is a perfectly competitive market and all the market situations are stable. Homogeneous risk classes of firms. So there is a proper homogeneity between the risk classes of the firm with respect to the equity and debt financing. Expectation about the net profit income. There is no excessive expectation with the net profit income, that is whether it may be much higher or much lower. So there is no greater expectations from your net operating income. 100% payout ratio with respect to your dividend. Same approach with respect to general assumptions of the capital structure theory. It clearly mentions that it is having a 100% payout ratio with respect to the dividend, and there is absence of corporate taxes. So no corporate tax in the sense. Now here at this point of time, it is taking into consideration two perspectives. There is presence of corporate tax and absence of corporate taxes. Next assumption is the information is available at free of cost. So whatever the information that you need, whatever the analysis that you want to make, every information or analysis is done free of cost, and there is no additional cost incurred by the firm for valuation purpose. The same information is available for all the investors. So whatever may be the type of information that you are dealing with, whatever may be the type of information that you are maybe sourcing out, the same information is available for all the investors, whether it may be a debt investor or whether it may be equity investors. Securities are infinitely divisible. So all the securities are properly and infinitely divisible with a certain number. So a proper optimum and a mixture and combination of equity and debt is been made by the investors in a company. Investors are free to buy or sell the security. So there is proper freedom of transaction. There is no absence of absence of transaction cost, and no additional cost is being charged to the investors. Same point of time, the investors are free to buy or sell the security. So if a particular investor feels to buy a security or if he wants to sell the security at any point of time, the freedom or feasibility is available at every point of time. Next perspective is with respect to the there are no bankruptcy costs. So there is no certain situation or a certain scenario wherein you have to incur a certain cost with respect to your bankruptcy. So there is absence of bankruptcy cost or your cost which may be incurred in an additional position. Investors can borrow with restrictions as same terms on which a firm can borrow. So there is no difference in opinion or difference of rules and regulations and restrictions with respect to the borrowing. So the investors can borrow the same amount or can invest the same amount with respect to the same terms in which a firm can borrow. So same rule applies for a firm also and for an individual investor also. Dividend payout ratio is 100%. So same point of time, 100% payout ratio, it clearly mentions that whatever the amount that has been earned, whatever the profit is it has been obtained, the 100% dividend payout ratio is available and applicable at every point of time, wherein it is clearly mentioning that EBIT is not affected by the use of debt. So whatever may be the amount of profit that is made available, whatever may be the earnings before the interest and tax applicability is not getting affected by the use of debt. So debt financing is not directly impacting your organization's capital structure. Now, coming with the first perspective of Modiglani and Miller in the absence of corporate taxes. So according to this theory, total value of the firm must be constant irrespective of degree of leverage. So that is the debt equity ratio, and it can be justified by an arbitrage process. So if in absence of the corporate taxes, it has been assumed that there is a proper valuation of the firm, the total value of the firm keeps on increasing or keeps on, it becomes stagnant, and there is no impact on degree of leverage, whether it may be a financial leverage or an operating type of leverage, it does not get affected by the composition of debt and equity. This approach is similar to the net operating income approach when taxes are being incurred. So here at this point of time, the taxes are incurred. So here majorly it is a combination, or it is a much replication of NOI, that is net operating income approach. It means that the capital structure decision of a firm is not affects its market value. So the market value of the firm does not get affected with the composition or the decision of capital structure with respect to the debt and equity. Next perspective is with respect to the when corporate taxes are assumed to be existed. So if we are assuming that corporate taxes are into existence, then what may be a situation? So according to this value, the value of the firm increases and the cost of capital decreases with the use of debt if corporate taxes are considered. This is because the benefit of tax because of interest on taxes deductible expense. So due to this, because now if corporate taxes are into existence, what happen? You have to pay a certain sum of money and your net income or the net operating income or your total capital keeps on decreasing. So at this point of time, if your benefit of tax is a deductible expense, what happen? Your capital value is decreasing and your overall cost of capital is increasing. So at this point of time, with respect to the inclusion of corporate taxes, your valuation of firm keeps on changing. Now, the perception of what is an optimal capital structure. Optimum capital structure is a capital structure at which market value share is maximum and the cost of capital is minimum. So whatever may be the concern, whatever may be the situation, the optimum capital structure defines a certain position wherein your debt and equity is at a certain position, your combination, your mixture, your composition of debt and equity capital is of a such a nature that your market value of the market value per share keeps on increasing and the cost of capital is always minimum or at a reduced level. So a situation where your market price per share keeps on increasing and it is benefiting the investors or your shareholders or the firm as a whole, and it is controlling or creating a certain position wherein the cost of capital is at a minimum level, then that particular position can be called as an optimum capital structure position. And lastly, now coming with the quality or the components of sound capital structure. So in order to call your capital structure of a sound nature or of a qualitative nature, what should be the components or availability positions? The first thing, it is simplicity. Your capital structure, in order to be optimum, it should be always in a simple terms or a simple understandable way. So whenever you say you have a capital structure of a debt and equity, it should be designed in such a way that it should be as simple as possible. So in order to understand, 50% debt, 50% equity, 25% debt, 75% equity, and so on. So there should be no further complications with respect to your equity, debt, and preference type of capital. Flexibility should be minimum. So there should be a minimum amount of flexibility in terms of availment of finances or availment of your capital structure. So it should be quite flexible that if a particular firm wants to change its capital structure theory at any point of time, so that particular feasibility, that particular flexibility should be available with the firm at every point of time. Next perspective is with the the terms of risk factor. So association of risk should be at a certain level, at a certain position, that there should be a minimal risk in whatever capital that you are availing for. If a firm is going for a debt capital or if a firm is going for an equity capital, if the firm wants to incorporate the amount of taxes, or if they want to reduce the amount of taxes, if the firm wants to pay the dividend, or if the firm wants to do not pay or withhold the dividend, then all the factors, all the options should have a certain position that your risk factor gets minimized at every point of time. Minimum cost of capital at every point of time in order to acquire that particular capital, whether it may be an equity or of debt nature, the cost of capital for such acquisition should be minimum. The next qualitative factor is with respect to the sufficient liquidity retaining. So whatever the amount that you are holding or whatever amount that you are raising for, it should have a sufficient liquidity retaining perspective. So that particular amount should be liquidly available with you, so that at any point of time, however it is, in what way it is been required, you can optimum utilize the resources and put to the firm for its composition. Next thing is with respect to the control. So a proper control of the top management and the middle management should be made available, wherein an information with respect to the how the composition should be made, how the optimum mix should be made, and in such a way that the control of management is needed to be required, wherein it decides a certain position or a certain structure, wherein a proper equity and debt structure has been designed and it has been providing a constant rate of returns to the organization. And lastly, avoidance of unnecessary restrictions. So with respect to the restrictions perspective, unnecessary restrictions should not be into presence and it should be seen that it is avoided. Why? Because it may create a certain situation that the structure may get damaged and you may have a certain position that you may not benefit from a debt financing or an equity financing. So in order to increase your continuous on a return basis, what you need to see that the unnecessary restrictions are avoided and the firm is automatically or completely benefited out of it. That's all for the today's lecture. Here with this concern, we come to end of the capital structure theories. So in order to briefly summarize, we have seen today's the different sources of capital. We have seen the different sources of financing. We have seen what are the different types of this and optimum capital structure. And with respect to the capital structure theories, we have dealt with the 4 types of capital structure theory with respect to the Modigliani and Miller approach, the traditional approach, the net income approach, and the net operating income approach. Thank you for your patience listening. Good day. So I'll be posting the attendance link. Please hold on for a second.